Today, XRP touched $1.27. U.S. airstrikes hit military sites in Iran. Oil tankers turned back in the Strait of Hormuz. Greek fleets rerouted. Saudi crude sitting still in the water. The financial media lit up with doom and gloom. Crypto panic sellers piled in. People started calling for XRP under $1 before the day was out. And then something happened that almost nobody in this space is able to explain. XRP reversed. It broke to the upside. It went green. In the middle of a genuine geopolitical flashpoint, the kind of event that historically sends risk assets into freefall, XRP found buyers and moved higher. Most people saw that and called it noise, a dead cat bounce, a fake out. I saw something completely different. And today I'm going to show you exactly what that price action was actually signaling, because it connects directly to a theory that was called crazy 2 years ago and is now, piece by piece, coming true in real time. The dominoes are falling. Most people just haven't counted them yet. Section 2, Credibility Bridge, 15 to 30 seconds. Welcome back to Common Sense Crypto. I'm Rich. No panic, no doom, no premature victory laps. Just calm, rational analysis of what is actually happening in this market and what the data tells us about where it's going. Today we are connecting 3 things that most people in this space are treating as separate stories. The Iran conflict and oil shock, the domino theory that has been playing out for nearly 2 years, and what South Korea's 33% share of global XRP volume tells us about what happens next. This is the thread. Let's pull it. Let me start with a question that almost nobody asked today when XRP bounced off that $1.27 low. Why did it bounce? Serious question. In the middle of a geopolitical shock, airstrikes, oil disruption, global risk-off sentiment, why did a crypto asset that has been correlated to Bitcoin, that has been following macro risk sentiment for months, suddenly reverse and go green? What changed in that moment? Here is the concept most people in this space have never been taught to look for. Crisis liquidity rotation. When traditional financial systems come under stress, and a conflict that threatens Strait of Hormuz oil flow is exactly that kind of stress, sophisticated capital does not simply sit still. It moves. It looks for assets that can function as liquid, neutral, borderless stores and vehicles of value during periods when traditional rails are unreliable, strained, or outright unavailable. Gold has historically been that asset. But gold does not move in 3 to 5 seconds. Gold does not settle cross-border transfers for under a penny. Gold does not bridge currency corridors in real time during a geopolitical disruption. XRP does all 3. Now I want to talk about Jake Claver's domino theory, because I think this is the most important analytical framework for understanding where XRP sits in the global financial picture right now. And most people dismissed it as conspiracy theory when he published it nearly 2 years ago. Here is the theory in plain terms. Oil spikes due to geopolitical conflict. Japan, holding enormous amounts of U.S. treasuries as part of its foreign reserve strategy, faces pressure on its own bond market. To defend its yield curve, Japan raises rates and begins rotating out of U.S. treasuries. Those treasuries flood back into the global market. Bond prices fall. Simultaneously, demand for stablecoins, driven by the just-passed stablecoin legislation, absorbs approximately $2.3 trillion of that returning treasury supply. The bond market gets shored up, but in the process, a broad repricing event hits risk assets. Bitcoin, gold, equities, everything takes a significant haircut. Tether comes under depegging pressure as exchange liquidity tightens. And then, this is the critical mechanism, exchanges running low on liquidity need a neutral, decentralized, globally accessible bridge asset to keep operating. They need something no single entity controls. They need something that settles in real time. They need XRP. That is not a fantasy. That is a logic chain. And today, with Strait of Hormuz traffic rerouting and oil prices preparing to move, the first domino in that sequence just got nudged. Let's make this concrete with numbers, because the math here is what transforms a theory into a structural argument. Jake Claver himself stated something in his most recent commentary that I want you to hold on to. He believes there are fewer than 100 million XRP left on OTC desks and dark pools. Let me explain why that number is so significant. The OTC market is how institutions buy large amounts of XRP without moving the visible spot price. Instead of going to an exchange and placing an order that telegraphs their position and moves the market against them, large buyers go directly to OTC desks, intermediaries who aggregate supply and sell in bulk at negotiated prices. This is how institutional accumulation stays invisible to retail. It does not show up on a price chart. It shows up as exchange reserve depletion over time. If the OTC float is genuinely down to fewer than 100 million tokens, that represents a critical threshold. For context, 100 million XRP at current prices is roughly $135 to $140 million. That sounds like a lot. But for a sovereign wealth fund, a major bank, or a large institutional player entering a position, that is an afternoon's work. It is not a deep market. It is a shallow pool. And when the last OTC supply is absorbed, the next buyer has to go to the open market. When they go to the open market at scale, price discovery becomes violent. Now layer in the South Korea signal. South Korea drives 33% of global XRP trading volume. 33%. Of the entire world's XRP trading activity, one country, one relatively small economy by global standards, accounts for 1/3. This tells you two things. First, XRP's adoption is globally distributed in a way that Bitcoin and Ethereum are not. Second, Korean traders are not passive holders. They are active. They move in volume. They react to news. And when Korean volume enters the market in force, typically in what appears to be middle-of-the-night moves for US audiences, it is because Korean traders saw something in the data or the news cycle that triggered a position. When the next major catalyst hits, regulatory clarity, a BlackRock ETF application for XRP, a confirmed stablecoin bill, and Korean volume at 33% of global trade reacts simultaneously with institutional inflows from newly legal US allocation vehicles, the demand spike will be unlike anything this asset has seen before. And then there is the BlackRock signal. Jake Claver specifically anticipates a BlackRock XRP exchange-traded product in 2026, timed in his model to arrive precisely when the other catalysts have played out and when institutional demand for a vehicle to re-enter risk assets after a repricing event is at its peak. BlackRock does not enter markets speculatively. When Larry Fink's firm files for an XRP product, it is because they have already modeled the demand, secured the regulatory pathway, and identified the institutional clients who will allocate into it on day one. That product does not exist yet, but the conditions being built around it are accelerating. Let me show you what is happening at the institutional level right now, because the retail narrative and the institutional reality are two completely different stories being told about the same asset. Brad Garlinghouse said this week that the door to a deal is wide open. The banks just need to act in good faith and walk through it. Read that carefully. Ripple's CEO is not negotiating from a position of weakness. He is holding a door open and telling the traditional banking system that the opportunity is there when they are ready to take it. That is the posture of a company that knows what it has built and is confident enough in its position to wait. And consider what he is waiting for them to walk toward. The digital prime broker framework that Ripple published, a full institutional trading blueprint that eliminates counterparty risk, aggregates liquidity, and settles on the XRP ledger, is not a pitch deck. It is an operational design document that any bank or hedge fund can take to its engineering and compliance team today. The infrastructure to implement it already exists. The ledger is live. The ODL corridors are live. The only thing missing is the formal regulatory clarity that allows institutions to say publicly what many of them are already doing privately. And here's the geopolitical dimension that almost no analyst is connecting right now. When a conflict disrupts the Strait of Hormuz, what happens to cross-border payments in the affected region? What happens to correspondent banking relationships when oil-exporting nations are under military and economic pressure? The traditional nostro-vostro system, the pre-funded accounts that banks maintain in foreign currencies to facilitate international transfers, becomes strained. Funds get frozen, transfers get delayed. The $27 trillion sitting in idle nostro-vostro accounts globally becomes even more locked in place. XRP's on-demand liquidity system bypasses that architecture entirely. It does not require pre-funded accounts. It does not require stable correspondent banking relationships in every corridor. It requires two things: a liquid XRP market and a connection to the XRP ledger. Both exist today, And in a world where geopolitical conflict is disrupting traditional payment infrastructure, the asset that can move value across borders in 3 to 5 seconds for under a penny is not just useful, it becomes essential. The EZA signal is worth paying attention to here. Geopolitical conflict is long-term bullish for crypto, regardless of short-term volatility, because people everywhere need a safe place for their assets and a neutral currency to use. Blockchain is the safe haven infrastructure. XRP is the settlement layer of that infrastructure. That thesis just got its first real-world stress test today, and XRP passed it. Let me map the sequence from here, because understanding the order of operations is critical to understanding how to be positioned. Step 1 is regulatory clarity. Brad Garlinghouse has said it clearly. Everything else flows from this. The stablecoin legislation, the market structure bill, the Digital Asset Clarity Act. These are in motion. They are delayed, but they are moving. And the Iran situation, as strange as it sounds, may actually accelerate the timeline. When the financial markets are under geopolitical stress and legislators are watching risk assets move in ways that traditional instruments cannot explain, the argument for clear digital asset regulation becomes more urgent, not less. If the Clarity Act passes during a period of active geopolitical tension, it will not look like coincidence. It will look like infrastructure management, because that is exactly what it is. Step 2 is the OTC floor. Jake Claver's estimate of fewer than 100 million XRP remaining on OTC desks means that the quiet institutional accumulation phase is entering its final stage. When that supply is absorbed, the next buyer pays open market prices. The compression is almost complete. Step 3 is the BlackRock product. Whether it is an ETF or an exchange-traded product of another structure, when the world's largest asset manager files for an XRP vehicle, it signals to every other institution that the compliance pathway is clear and the allocation mandate is legitimate. That filing will not come without warning. There will be a registration signal, an SEC submission, a paper trail. Watch for it. Step 4 is the Korean volume amplifier. Whatever catalyst triggers the breakout, 33% of global trading volume will respond from a single, highly active market. When Korean traders move in the same direction as institutional ETF inflows and regulatory clarity simultaneously, the price action will be unlike anything in this asset's history. The dominoes are numbered. They are lined up. The first one was nudged today. Here's the question I get more than any other. Is it too late? The answer is no. But I want to give you an honest framework for why, not just reassurance. Exchange reserves for XRP are at multi-year lows and declining. OTC supply, by credible analyst estimates, is in its final compression phase. The float, the XRP actually available to new buyers at market prices, is smaller today than it was 6 months ago, and it will be smaller 6 months from now than it is today. Meanwhile, the demand infrastructure is expanding. A live ETF, active ODL corridors in Japan, Southeast Asia, Turkey, and the EU. A digital prime broker framework that hands institutional clients a turnkey integration path. A BlackRock product potentially in preparation. 33% of global volume sitting in one of the world's most crypto-active retail markets. And a geopolitical environment that is, for the first time, creating real-time demand pressure on neutral cross-border settlement infrastructure. Every day that passes, the gap between available supply and incoming demand gets a little tighter. The window does not slam shut on a specific date. It closes gradually, and then all at once, it is gone. Buy what you can afford. Dollar cost average consistently. Secure your holdings properly. Keep quiet about what you hold, and let the math do the rest. I want to say something to the people who have been called crazy for holding through this cycle. Every delay, every red month, every geopolitical scare that knocked the price down, every coworker who told you it was going to zero, every YouTuber who called your thesis speculation, every moment where it looked like the breakout was coming and something happened to pull the market back. You are still here, and that means something. The people who hold through periods of maximum pain are the same people who are positioned for periods of maximum gain. There is no version of this that rewards the impatient. There is no shortcut through the crucible. The face-melting phase, as the technicals are starting to suggest is approaching, does not reward comfort. It rewards the people who endured the discomfort first. You are not a psychopath for still being in crypto right now. You are someone who did the work, understood the thesis, and had the discipline to hold the position. That discipline is about to matter more than anything else. Let me bring all of it together. Today we watched XRP drop to $1.27 on Iranian airstrike news, and then reverse and go green while the rest of the market was still processing the shock. That is not random. That is a signal. It tells you that buyers exist who see this asset differently than they see other risk assets. It tells you that the thesis of XRP as crisis-resilient, neutral, borderless settlement infrastructure is not just theoretical. It is being tested in real time, and it is holding. The domino theory that was called crazy 2 years ago is unfolding piece by piece. The Strait of Hormuz is stressed. Japanese treasury rotation is a documented risk. Stablecoin legislation is in motion. OTC supply is in its final compression. A BlackRock product is anticipated. And the regulatory clarity that unlocks institutional floodgate demand is closer than it has been at any point in this asset's history. South Korea is watching. The institutions are positioning. The OTC desks are running dry. The ETF pipe is live and waiting for volume. This is not the time to lose patience. This is the last stretch before the starting gun. The people who are going to buy XRP at $20, at $50, at 3 digits, they haven't arrived yet. They are coming. They will come when it is on every news channel and in every bank app and their financial advisor is calling them. They will buy with FOMO and regret and pay whatever price is there when they arrive. You are not them. You are the person who was here when it was quiet. Stay here. Drop Domino in the comments if you made it to the end of this one. I want to know who is connecting the dots. This is Common Sense Crypto. I'm Rich. Stay patient, stay rational, and as always, we don't wait for the future, we plan for it. See you in the next one. Have a great night.